monthly webinar here in 2024. So glad that you were able to attend. Thank you for taking time to be a part of this today. What better way to celebrate spring and then to talk about taxes? A lot of you have probably are in the midst of filing your taxes for 2023, or you've already done that and you have that burden off your chest now. But what we want to talk about today is 7 steps to maximize your income and minimize taxes. And this is something that we all have to face. We all have to figure out how do we minimize our taxes? What taxes do we owe when we go to file our taxes? And so what we want to do is talk about what is the tax management journey and what does that mean for you, whether you prepare for retirement or if you're already in retirement, how do you mitigate those taxes moving forward? Now, one of the most important things that you have to understand when it comes to taxes is not all money is taxed the same. Now, you've probably heard things or you've seen on the news people like Warren Buffett, Mark Zuckerberg, Jeff Bezos, and you've probably heard stories that, hey, they pay less in taxes than some of their employees do. And you're like, how did these billionaires get away with doing it? Well, they've learned this concept. They've learned that what they are able to do is they have ownership of capital in their business and in their stock that they own versus W-2 income that a lot of their employees have. And because the capital in those sources is taxed preferentially, they're able to pay less taxes than maybe some of their employees. And so they have learned the concept and they've learned the tax code. And you can see on the screen there that over time, the tax code has gotten a lot larger. It's more complicated and it's more difficult to understand. And the reality of it is it's not going to get easier. It's probably just going to get more complicated. And so when we get back to this concept of not all money is taxed the same, when you understand that and you understand some of the rules of the different buckets and the different assets that you have and how they're taxed, that will help you put together a well laid out plan. Now, here's the reality, and a lot of people don't realize this, but for most, taxes are the single largest expense that you have, both as you are working and in retirement. Let me repeat that again. For most people, taxes are the single largest expense. But when we go and do our retirement plans or we plan a strategy, a lot of times we don't keep this in mind, that this is the largest expense that we have. And so a lot of times when we meet with people, we see that people don't keep this in mind and they don't plan accordingly for that largest expense that they have. So what we want to talk about is how can you maximize your income and minimize taxes by going through what we call the tax management journey. Now, here's the thing that you also have to understand. Tax planning is different than tax management. A lot of people think these are the same, but tax planning is basically filing your taxes. It's doing a return, where tax management is how you mitigate and put a plan to mitigate those taxes, not only as you're working, but in retirement. How do you mitigate those moving forward throughout the course, either as you prepare for retirement or as you enter into retirement? So many of you have seen this in the past. This is our U.S. debt clock. And when you look at it, it's extremely overwhelming. And when you put a close-up of the U.S. national debt, it's around 33, and it increases every single day, but over $33 trillion in debt. And that is really overwhelming. And so when you think about that, that's over $100,000 of debt per person in the U.S. It's actually over $259,000 per taxpayer. And so when you look at this debt, what you have to come to realize is the way that we are operating as a country, it's not sustainable. This cannot be sustained. So if it can't be sustained, what does that mostly mean for all of us? And the moral of that story is that taxes more than likely are going to increase. There's really no way around it. So when you understand that and you understand that taxes are going to go up and we can't sustain the way that we're doing things right now, it's that much more important for us to prepare for how we mitigate our taxes moving forward. One of the things we got to understand is how the 2017 Tax Cuts and Jobs Act impacted our tax brackets.
So in 2017, if you're married, I want you to focus on the left-hand side of the screen. If you're single, I want you to focus on the right-hand side of the screen. But you can see the tax brackets for regular ordinary income prior to the Tax Cuts and Jobs Act being implemented and where we are today. So if you look at the comparisons, what you see is the way that it was the 15% tax bracket was reduced to the 12% tax bracket. 25% was reduced to 22, 28 was reduced to 24, 33 was reduced to 32, 35 stayed the same, but you can see that in the way that the brackets are now after the implementation of the Tax Cuts and Jobs Act it's a much larger bracket, and then the 39.6 went to 37. So at the end of 2025, beginning of 2026, if Congress doesn't do anything and there's no revisions that are implemented prior to the beginning of 2026, this is going to revert back to where it was prior to the implementation of the 2017 Tax Cuts and Jobs Act. So what we know automatically, even in the near future, is that taxes are going to go up just because this is automatically going to revert back. Some people say this is the sunset of this particular Tax Cuts and Jobs Act. So this is really important to understand. It's important to understand where the tax brackets were, where they are now, and if nothing is revised or changed, where it's going to go. So we know even in a couple years that automatically our tax brackets are going to increase. So with that, then we have to understand, what is tax management? How does this apply to me? And how do I effectively manage taxes with what I have moving forward? So when we think about tax management, the first thing we think about is not all money is taxed the same. We talked about that before. We're going to talk about the different types of assets, different types of accounts that you have, and how those are taxed. But it's important to understand that not all money is taxed the same, and they all have a different tax environment. The second thing is there is a tax efficient order of your money. Some people would talk about this with you if you've worked with an advisor, if you've worked with us, that there is an order of how you want to save for retirement, but then there's also a proper order of how you withdraw those funds from your retirement account. So a tax efficient order, both in saving assets and also withdrawing from them as you enter retirement. And then thirdly, the continual process of maximizing income by minimizing taxes. So this is an important concept to understand, that when you think about tax management, this is not something that you look at maybe in February or March as you get ready to file for your taxes and do your tax return. But this is something that is a constant process. It's a constant planning to help you minimize these taxes moving forward. So it's a continual process when you think of tax management. It's not just filing the return, but it's a continual look and management of the assets that you have to see if there's a way that you can mitigate your taxes moving forward. As I mentioned before, tax preparation is not tax management. So tax preparation is simply you filing a return, and it's telling the IRS what you owe or if you are entitled to a refund. That's it. It's not the same as tax management. What I want to stress is tax management should be something that is a continual process, that you're having constant discussions with you and your advisor on a regular basis as you do reviews, whether it's quarterly or whether it's on a biannual basis. But that conversation and that planning should continue to happen. So let's talk about lifetime tax burden. And this is something when you think about, man, taxes are just what it sounds like. It is a lifetime tax burden. Things that I'm going to constantly know. What do they always say is, what is certain? There's nothing more certain than death and taxes. Those are the two things that are always going to be certain in your life. And so when we think about this, we think of the three distinct phases to tax management. One is our working years. How do you mitigate taxes during your working years? How do you plan for taxes while you're working and you're saving? Is there a way that a lot of people, when they approach it, especially if you're a business owner, is how do I pay the least amount in taxes as I'm working during your working years? The second is in your retirement years. A lot of times when people are working and they're planning and they're trying to mitigate taxes while they're working, they don't think of the impact of what that means in retirement. So this is the second phase to this. And then the third phase is when you pass away. So there are things that have recently been passed in the Secure Act, the Secure Act 2.0, that recently have even changed what that means when you pass away, the different assets that you have, when your kids possibly inherit those assets, what that means. And so there are different rules and phases that apply to each of these three. So when we look at these, what we want to do is take any of the clients that we work with on what's called this tax management journey. And we're going to go through each one of these 7 parts of the journey. And what this allows us to do is it helps us to protect what took a lifetime to accumulate. You've worked hard for what you saved over the course of your working career. And so it's important to you to make sure that you minimize what you're going to pay and maximize what you're going to be able to receive from those assets. Now, the way that we do this, the way that we put this tax management journey is laid over top of what we call the bucket plan. For many of you that you've had the opportunity to work with us, you've heard us talk about the bucket plan. This is the foundation of the retirement plans that we put together. And once we put this bucket plan together, when you have your 3 now, soon, and later buckets, and you segment your assets based on your specific situation and your specific objectives, and we segment the money in these buckets, then we can manage the taxes after we put the bucket plan together, and we can go through this tax management journey. So when we start, we first have to understand the order of money. And so when you think about the order of money, you have to understand the different types of funnels or the different types of accounts that are out there that are going to have a different implication on how the taxes are paid. So let's first start with a pre-tax funnel. Many of you, most of you, probably have the majority of your assets in either 401ks or IRAs. And the reason why that so many of us have done this is because we take a job, the employer matches contributions that we put in this, and that's the reason why that we start with this pre-tax funnel. And if you can get a match or an employer is going to contribute what you've put in, you want to take advantage of that. A lot of times, especially if you are getting close to retirement age, that is going to be in a pre-tax funnel. So contributions are made pre-tax, meaning taxes are not paid on those contributions. And then distributions from those accounts are taxed at ordinary income taxable rates. So 100% of any distribution that you take is going to be taxed, and the current rates are going to be anywhere from 0 to 37%, which is consistent with the current tax brackets. The next funnel is what we call the tax advantage funnel. And these are different types of accounts that contributions are made with after-tax dollars. And the great thing about these type of accounts is they grow tax-free, but then distributions from the accounts are taken completely tax-free. Many of you are familiar with Roth IRAs. Roth IRAs and cash value life insurance are 2 vehicles, if they are structured correctly, where they're going to grow tax-free, and then as the account values build, you can take those distributions completely tax-free. FSA, health savings accounts, 529 plans, these are other types of accounts that are also, if you use these appropriately and you use them as they're designated and designed, these are also going to be taking distributions in a way where taxes are not going to be owed. And then you have what's called the post-tax funnel. And the post-tax funnels, a lot of times people will look at these accounts where there's a double taxation. Contributions are made with after-tax dollars, but then as you take a distribution or maybe you sell a position, depending on the type of account you have, you're going to pay long-term capital gains taxes. So if you have a brokerage account or a taxable account that is set up where you're investing in stocks or mutual funds, you're going to contribute into that plan. As that position is sold, you're going to pay long-term capital gains tax. And in order for it to be a long-term capital gains, you need to hold that particular position for more than 1 year. And the rates that would apply to that are going to be 0 to 20%, which is different than ordinary income tax. So as we think about this and how different accounts are taxed differently, let's look at a comparison of a traditional withdrawal strategy versus someone that maybe went through the tax management journey and has an understanding of how the different taxes work. So let's say we have a couple here, and collectively they're going to collect a Social Security benefit of $40,000. In addition to that Social Security benefit, now there's an IRA withdrawal of $50,000. And then there's some interest income. Let's say they have a money market that has earned some interest. They take that $4,000 and their annual income that they're filing on their taxes is $94,000. When you look at the tax return, the federal taxes that are due for this particular couple was just over $6,800. Now, let's compare that to somebody that took a different approach with the same amount of money. Let's say the same couple took $40,000, or they were able to receive $40,000 from their Social Security benefit. But instead of taking the $50,000, now they took a $15,000 IRA withdrawal. They still needed the same level of income, so they took their income from other sources. So let's say now, as part of the soon bucket, this particular couple was able to get qualified dividends in the form of $9,000. In addition to that, they were able to take $15,000 from their brokerage account. It was a post-tax strategy, so another $15,000 from there, and then they were able to take a $15,000 distribution from their Roth IRA, which we know when you take that distribution, no taxes are owed on that. So when this couple filed for their taxes, their annual income was the same amount as far as what they received. It was still that $94,000, but the federal taxes due with this particular situation was zero compared to $6,800 from the prior example. Now, I want you to think about that. Same money, same level of income that both examples lived off of, but one example was a $6,800 tax bogey, where the other one, no federal taxes were due. That can be significant. When you think about that, that's a vacation. That's a really significant gift to somebody, or something that you can do something fun with. So how you manage your taxes and how you take those distributions can have a pretty significant impact on your overall retirement. Let's look at number two. Now, the reason why we want to be able to measure our tax bracket is this is really important when we plan for how we take those distributions out, knowing where our brackets and where we fall within these brackets. We like to think of these as a giant measuring cup. And when you think of these as a measuring cup, what you can see are the different brackets. If you're married, I want you to focus on the left-hand side of the measuring cup, or excuse me, if you're single, follow the left-hand side. And if you're married, I want you to follow on the right-hand side. And so what you see here is the spillover effect, or how progressive tax structure works. So if you have an income up to $23,200, the tax bracket that you're going to fall into is 10%. Anything over that $23,000 up to $94,000, if you're married, is going to fall in that 12% bracket. And you can see how that continues to work. And so you can see the big jump there between 12% and 22%. And then the other big jump is between that 24 and 32% brackets. Now, everybody is going to get a standard deduction. So a standard deduction, the way that it works right now, is everybody gets $14,600. And if you are over the age of 65, you actually get another $1,550 per person. So if you're married, that's an additional $3,100 of standard deduction that you're going to get, including that $29,200. So that's an important concept to understand as you're looking at the different brackets that you fall into. And this is really important as you plan things like, do I need to do Roth conversions? Where does that put me at different income levels? And how does that place me on this particular chart? And where does it spill over within the individual and married income tax rates? But this is, again, another important concept to make sure that you understand is not, if you're in the 22% bracket, not 100% of your income is taxed at that 22%. It's anything over that $94,000 if you are married. Now, Another thing to understand too is when we think of legacy planning, a lot of times we think about legacy for our kids, but we don't think about legacy for our spouses. So if you're married and you're on that right-hand side and you think about, okay, right now I am at $100,000 of income, which puts you a little bit into that 22% bracket. Well, let's say you pass away and your spouse is still living. Well, a couple things happen. The standard deduction is now cut in half, and the way that the brackets are going to change. So now the survivor who was in that 22% bracket, if you need the same level of income to live off of, you are now in that 100% bracket. So standard deduction is cut in half. If you're taking Social Security at that time, your benefit goes from 2 benefits to 1 benefit, and now you're also jumped into the next higher tax bracket on a lot of occasions. So things to be aware of, things to understand so that you can plan appropriately as you're trying to figure out how to manage your taxes as you are in retirement. Let's look at the next one. The next one is avoiding marginal tax traps. And one of the biggest ways that we see with tax traps is what we call the Social Security torpedo. A lot of people, when they get ready to plan for Social Security, they find that it's really overwhelming to understand the different rules that apply to Social Security. But what a lot of people don't realize is that most people pay taxes on that Social Security benefit. You're like, what the heck? I don't understand that. I've paid my FICA taxes for that Social Security benefit, and now you're telling me that most of us are going to have to pay taxes on that benefit. And that's true. And what you want to be aware of, and this is going to get into a whole nother session that we do at some point, is how you can even mitigate the taxes on your Social Security benefit. And that is based on what we call the provisional income. And so how do you minimize the provisional income while at the same time maximizing the income that you receive? And so this is something that you want to be aware of. Talk to the advisor that you're working with about how to minimize those taxes for your Social Security. Then you get into allocating tax-sensitive assets. And so just like if you think of a portfolio that you have, and if you're working with us for any amount of time and you have any sort of wealth management strategies with us, you've heard us talk about the importance of diversification, how you diversify those assets inside those investment accounts. And it's the same thing with your taxes, is you don't want to have all of your assets in one sort of tax environment. It's important to have them diversified just like you would in investment. And so owning the right investments in the right accounts for tax optimization is another way that you go through the tax management journey to mitigate those taxes in the future. Also want to look at what we call gifting strategies. Whether it's for charitable giving or intra-family gifting, there are a few easy ways to gift money that are going to help you in the long run. One example that I can speak to this is if you have stocks or you have a taxable account with different funds that have a lot of gains on those, and you don't necessarily want to sell those positions because of the long-term capital gain, you could donate the stock directly or the mutual fund directly to that nonprofit. If you itemize your deductions on your returns, you get that deduction and you don't have to pay the long-term capital gain. There's a lot of different strategies like I just mentioned that you just have to be aware of. Intra-family gifting, that's another important concept, but even understanding what your tax implication is going to be depending on how you leave assets behind at your passing. So does it make sense to do some gifting while you're alive to maybe minimize some of that at the time of your passing? So just things that you want to always consider and things that you always want to discuss as you plan. Remember, I said this is a planning process that never stops. It doesn't just come up in February and March, but something that you want to talk about on a regular basis. And then the pay now or pay later concept. So this is something that we always have to think about, specifically as we're planning and saving into retirement. Do I do a pre-tax? Do I do an IRA? If I'm a business owner, do I do a SEP? Do I do a Roth? There's different consequences. There's different benefits to each of those. But the reality of it is you're either going to pay now or you're going to pay later. And so you have to understand what's going to be beneficial to you in the long run of when you pay and how you pay. So as we get back to our US debt clock, really important to remember that we're in an environment that's not sustainable. And when you think about this environment, understand there's going to be more changes that are coming. And more than likely, those changes mean a higher tax, either a bracket or more taxes to you as the taxpayer, which is why we feel like going through this tax journey together is important to mitigate these particular expenses that you have. And like I said, it's going to be your biggest expense for most people. And then managing that bracket. Now, here's the thing. We know there's going to be continual changes that occur. We had two recent changes that I mentioned earlier. 2019, we had the Secure Act, and then recently we had the Secure Act 2.0. And those Secure Act, they changed a lot of things, but two, what I would say significant changes that were made were just the required minimum distributions. Both times they were changed. At first it was 70 and a half. Now it's 70, when it was 72, now it's 73. For some people that are watching this, it's even going to be 75. That change has continually made, and it was made recently. The other change that was made recently is how, if you have pre-tax money, how that is left to your children, and what they're going to have to do is pay and spend that down over 10 years, and what that may mean for their taxes, and what that means, how it could possibly even bump them into a higher tax bracket when they receive those funds. And so as we look at the 2017 Tax Cuts and Jobs Act, as we talked about before, how it reduced those brackets, we know that it's going to sunset, and in 2026, it's going to go at least back to where it was unless they make some changes prior to that. So if nothing is done, it's going to go back to where it was in 2017. Now, what that means is right now, taxes are on sale. And you may be thinking, well, what do you mean by that? Well, if you've worked with us, we may have mentioned the idea of Roth conversions. And if you are doing Roth conversions, now is a great time to do it if it's applicable to you, because right now the taxes are going to be as low as they ever will be. And so planning that and understanding the brackets of where you fall into, how you avoid that while at the same time when you're taking those distributions, understanding what that means, as I talked about that example earlier on in the presentation. So you have to ask yourself, where are you at in your tax management journey? Are you in a position where you're happy with the taxes that you're going to pay in the future, or do you have some work to do that you would like to talk to one of us about it so that you can minimize those taxes as you either get ready to retire or while you're in retirement? So if you feel that this is something that you need to have a discussion with one of us, as always, get a hold of Rose. Rose will be able to schedule you with one of the advisors here. We can talk about this with you, help you mitigate, put a plan together. As we talk about everything, having a plan is really the most important thing you can do, is understanding where you're at, understanding where you want to go, and putting a plan together to do this. So I want to thank you for taking this time today to go through this with us. So much information that we covered. I know it can be very overwhelming, but we're looking forward to working with you so that we can help you along this journey. Have a great rest of the day. Everybody take care.